did Ben Bernanke tell us back in 2016 what central banks, including the Federal Reserve, will do in the future. So back in 2016, we had the presidential election heating up. Donald Trump won the Republican nomination in April, and there were articles coming out in May by the mainstream media about how he had stolen the nomination and how he won and all this other stuff. So a lot of people in the alternative media, myself included, miss these things. Although I do have an excuse because in early 2016, I was still extremely sick. I was barely able to get out of bed at that point. I had really blurry vision and very bad liver disease, and I was extremely sick. 2015, the entire year, and the first few months of 2016 were very, very rough for me. So I went back. I was listening to a podcast with Jeff Gunlock, who's the Bond King, and he did this recent podcast, which I've been talking about, and some of my listeners told me about in the last week or so. And he mentioned something specifically about Ben Bernanke from a few years ago. He didn't know the exact date when it happened, and I was curious about it. I like doing research, things like this, stuff the mainstream media won't do, stuff a lot of people in the alternative media won't do, stuff people in the gold community won't do. And I don't remember this being talked about much. I don't remember this being mentioned. I do, as you guys know, check out a lot of sources in the alternative media and the gold community, as well as look for mainstream media sources as well. And Ben Bernanke actually in 2016, guys, he penned some very interesting stuff. He even did some TV interviews talking about it, and then he did a trip to Japan. So let me break this down for you guys in more detail. So in March 18th of 2016, Ben Bernanke actually wrote a long blog article on the Brookings Institute, because remember, he got hired there as one of his many jobs besides charging like people like David Einhorn $250,000 for dinner and all these consulting gigs. I think he got hired by one of the top hedge funds, Renaissance Technologies or one of them. And he also got another consulting gig besides academia, going back to academia and doing some work there because he has pensions there too. He wrote a blog article that I haven't heard anyone in the gold community or anyone in the alternative media talk about. And he wrote this on Friday, March 18th, 2016. And most people were probably, like I said, way too busy talking about the 2016 presidential election, how Trump was going to win the nomination. So the media was mostly covering that. And so this got buried. He wrote an article called "What Tools Does the Fed Have Left?" Part 1, negative interest rates. So Ben Bernanke, if you're not familiar with if you're not familiar with a lot of his thoughts, he initially only believed in ZIRP, zero interest rate policy, going to the lower bound. But it seems that he crossed the Rubicon and really changed his mind about that and going towards negative interest rates once he penned this blog article. And it's fairly long, so I could read some of it if you want, but it's pretty in-depth. And he started doing, not only did he pen this blog article, he started doing TV interviews on CNBC, Bloomberg, etc., talking about this, about how the Fed is not out of policy tools. So he says, I'll read his article now, a part of it at least. He says the U.S. economy is currently growing and creating jobs, a situation I hope and expect will continue. We can't rule out the possibility, though, that at some point in the next few years, our economy will slow, perhaps significantly. How would the Federal Reserve respond? What tools remain in the monetary toolbox? In this and a subsequent post, I'm not sure if he ever actually wrote another post. I looked for it. I spent about 20 or 30 minutes on multiple search engines looking to see if he did a follow-up article, and I didn't see one. He's going to discuss policy options the Fed might consider, focusing first on negative interest rates. Now remember, like I said, Ben Bernanke was not about negative interest rates initially. He was only about the zero bound. So he did not believe in negative interest rates at all. He only believed in ZIRP. But things had started to change in 2016, and Carmen Reinhart, member, had a great interview that I've referenced many times on McIlvaney in 2016 as well. So maybe Reinhart and Ben Bernanke were discussing these things about financial repression, Japanification, etc. Bernanke later in that year in 2016 even made a trip to Japan, and I'll talk about the trip and some of the crazy suggestions he made to the Bank of Japan, which may ultimately end up the Federal Reserve may ultimately end up doing. Just crazy stuff. Okay, so back to the article. So he'll conclude the post that the Fed is not out of ammunition and that monetary policy could help cushion a possible future slowdown. That said, there are signs that monetary policy in the United States and other industrialized countries is reaching its limits, which makes it even more important that the collective response to a slowdown involve other policies, particularly fiscal policy. A balanced monetary fiscal response would both be more effective and also reduce the need to use unconventional monetary tools. So first steps for easing policy. Given where we are today, how would the Fed respond to a hypothetical economic slowdown? Presumably the central bank's first response after dropping any plans to raise rates further, and we're seeing this now with the Jerome Powell Fed, would be to cut. And remember, quantitative tightening is supposed to end now in September. In fact, global QT, the QE programs are all ramping up by September. So dropping any further plans to raise rates further would be to cut short-term interest rates, perhaps to zero. Unfortunately, with the Fed funds rate, the Fed's target short-term rate now, and it's still not super high and likely to remain relatively low, moving to zero provides much less firepower than in the past. For comparison, the Federal Open Market Committee, the Fed's monetary policy making body, cut the short-term interest rate by 6.8 percentage points in the 1990 to 1991 recession, and its aftermath by 5.5 percentage points in the 2001 recession, and by 5.1 percentage points at the beginning of the Great Recession in 2007-2008. Well, guess what? The Fed does not have the ability to cut interest rates by 5% or 6%. It's just not there. So with the Fed funds rate near zero, it's not near zero anymore, but it's probably headed back there. The FOMC could next turn to forward guidance, that is, to communicating to markets and the public about the Fed's policy plans. If the Fed can convince market participants that short-term rates will stay low for some time, it can, quote, talk down and, quote, longer-term rates, such as mortgage rates, which are typically more important to consumers, businesses, and investors. When central bankers get together over a ginger ale, they like to call these efforts open-mouth operations. Wow, he's actually admitting they like to manipulate markets. Good job, Ben. The evidence suggests that forward guidance can be quite powerful, and if the amount of extra policy support needed is not too great, rate cuts plus guidance might be all that is needed. But what if it is not? The Fed could resume quantitative easing, that is, purchase of assets, typically longer-term assets for the Fed's portfolio, financed by the creation of reserves in the banking system. Like forward guidance, the goal of QE is to reduce longer-term interest rates to encourage borrowing and spending. It appears to work through at least two channels. First, the Fed's purchases push up the price and equivalently push down the yield of the assets it buys. That effect is transmitted through the system as investors who sold the assets shift into others, such as stocks or corporate bonds. Second, the Fed's asset purchases can help signal its intention to keep rates low for a long time. The Fed employed QE from late 2008 until October 2014, and the policy helped support the U.S. recovery and reduce the risk of price deflation. Yeah, because deflation is the enemy, and they stupidly named Bernanke Times Man of the Year. And there's lots of people that believe Bernanke actually saved us. Other major central banks are using it now. He's talking about quantitative easing, but the FOMC might be reluctant to turn it on again. It's hard to calibrate, and communicating about it is difficult. As we learned in 2013, when Fed talk about ending QE led to a taper tantrum in financial markets. It's also possible that a new round might be less helpful than before. And economists, whether you're an Austrian school economist or mainstream, you'd call this the law of diminishing returns. For these reasons, before undertaking new QE, the Fed might want to consider and this is a juicy part. For these reasons, before undertaking new QE, the Fed might want to consider other options. Negative interest rates are one possibility. Here we go, guys. Negative interest rates, general considerations. Several central banks, including the Bank of Japan and European Central Bank, have implemented negative interest rates. In practice, this means that instead of receiving interest on the reserves they hold with the central bank, banks are charged a fee on reserves above a threshold. The expectation is that to avoid the fee, banks will shift to other short-term assets, which drives down the yields on those assets as well, possibly to negative levels. Ultimately, the efforts of banks and other investors to avoid negative returns on the shortest-term assets should lead to declines in a broad range of longer-term interest rates, such as mortgage rates and the yields on corporate bonds. So basically, they want to the unintended consequences, though, with the yields on corporate bonds, the manipulation there is more junk bonds have been issued. So the amount of junk bonds now is over 3 trillion, which is a record. And I believe Jeff Gundlach said in the last 12 months that the size of the corporate bond market in the US in the last 15 years or so has increased fourfold. So with central banks driving down yields, with intervention, with market manipulation, with financial repression, the corporations have taken advantage of this to leverage up their balance sheets further, which means that a raise in interest rates was even more sensitive when you have that much debt on your balance sheet. And this is why there's a lot of zombie corporations, because they've been playing this refinance game. They can't pay off the debt. I believe the Bank of International Settlement said that 20% of all publicly traded corporations are zombies. So that's combining like US, Europe, and other countries. So back to the article. Generally, though, we'd expect these longer-term rates to remain positive because of the extra compensation that investors demand for bearing credit risk and for tying up their money for longer periods. By putting downward pressure on interest rates, most relevant to borrowing and spending decisions, the introduction of negative interest rates should work through the same channels as more standard monetary policies. The idea of negative interest rates strikes many people as odd. Economists are less put off by it, perhaps because they are used to dealing with, quote, real or inflation-adjusted interest rates, which are often negative. Since the real interest rate is the sticker price, and he says nominal, in parenthesis, interest rate minus inflation, it's negative whether inflation exceeds, it's negative whenever inflation exceeds the nominal rate. So he's talking about some charts and graphs here, which you can't see. You'll take a look if you want to see this article. For most of the period reflected, the Fed had no need to implement a negative interest rate policy. Until 2008, the nominal Fed funds rate was always well above zero, so that ordinary interest rate cuts remained feasible when needed. Since late 2008, however, the Fed funds rate has been barely above zero much of the time, so that achieving further reductions in the real funds rate would have required taking the nominal rate negative. In principle, at least, how much extra pop could this policy have delivered? If during this period the Fed had decided and been able to lower the short-term nominal interest rate to, say, minus 0.5%, then it presumably could have achieved a real Fed funds rate half a percentage point lower as well. So these are back to the academic drawing boards. Remember, there was a study in the last 8 months, I think it was earlier this year, from the PhD economists at the Federal Reserve saying that if there was negative rates, that the economy, the U.S. economy post-2008 would have recovered even faster. So they're ignoring reality. The reality of negative interest rates is the European Union and all the collateral damage. Go and read the articles that Daniel Lacaille, go and listen to the interview that I did with Daniel Lacaille, his articles about the European Union and the damage and collateral damage to savers, pension funds, banks, insurance companies. I could just name a list of all the different entities that negative interest rates have damaged. And Ben Bernanke is endorsing negative interest rates back then. And he had flipped. He was not initially, for years, he was not a proponent of negative rates, and then he had changed his mind. So by 2016, he had changed his mind to becoming a proponent of negative interest rates. And one more thing here is he visited Japan, and he went on a trip to Japan, it says, in August of 2016. Let me take a quick swig of water real quick. So Bernanke went on a trip to Japan in 2016, and this is going to get weird. So to cap it all, monetary policy wonks have seriously revived the zero coupon perpetual bond idea. There are currently two conflicting proposals on the table. Ben Bernanke, the former Federal Reserve chairman, on a recent visit to Japan, that was in August of 2016, reportedly suggested that Tokyo, the Bank of Japan, implement his helicopter money plans by issuing zero coupon perpetual bonds. And at that time, Ken Rogoff, a former chief economist at the IMF and currently a professor at Harvard University, has written a book proposing the abolition of cash in order to facilitate the latest monetary policy fad, negative interest rates. So the dollar bill, being an irredeemable, non-interest-bearing liability of the U.S. Treasury, is basically a zero-coupon perpetual. In his blog earlier this year, Bernanke suggested that the Fed could finance the government by printing money, receiving in exchange irredeemable Treasury script. Bernanke's latest bright idea is that the Bank of Japan, which is brought up close to well, it's more than half now of the country's outstanding government debt, and now the Bank of Japan now owns a very large chunk of Japanese exchange-traded fund shares, should convert its bond holdings into zero-coupon perpetual securities, that is, financial instruments with no intrinsic value. The difference between a central bank owning a zero-coupon perpetual note and conventional bonds is that the former cannot be sold to withdraw excess liquidity from the banking system. That means the Bank of Japan would lose a key tool in controlling inflation. So as expectations about rising prices blossomed, Japan's decade-long battle against deflation would finally end. Yeah, with runaway stagflation or worse, or a currency crisis leading to potentially psychological events and then potentially hyperinflation. Anyways, back to the article. There are further benefits to this proposal of Bernanke's. In one fell swoop, Japan's public debt overhang would disappear. As the government's debt service costs dried up, Tokyo would be able to fund massive public works. Prime Minister Shinzo Abe inclines towards more high-speed trail lines and defense spending. So, just ridiculous stuff. I have another article here. This one's actually pretty hilarious. So, on August 19th of 2016, this guy actually wrote a April Fool's article a while ago, 10 years ago, from 2016 to 2006. This guy, the author of this article, what's his name? Edward Chancellor for Money Week. He wrote a April Fool's article about how the Fed U.S. Treasury should issue zero-coupon perpetual bonds that would pay no interest and would never be redeemed to reduce debt service costs, and it was a total joke. But apparently now Ben Bernanke in 2016 is proposing that the Fed and the Treasury actually issue bonds that would pay no interest and would never be redeemed to reduce debt service costs. So I think, guys, ultimately, after potentially... Oh, and another thing about what... I don't have any notes. I'm just spitballing all this stuff off the cuff. Jeff Gundlach also said in that podcast he actually thinks that the U.S. will implement negative interest rates over the next couple years. So after the yields on the yield curve go lower, he thinks eventually the U.S. will start to implement negative yields. He thinks that there's been a paradigm shift, a major one at the Federal Reserve now, that a lot of these academics and policy wonks are okay with it. So back to this article now. The monetary policy wonks, in effect, are seriously discussing the idea of perpetual bonds, zero-coupon perpetual bonds. Ben Bernanke, the former chairman of the Federal Reserve, has suggested that the Bank of Japan, which has brought up so much of the Japanese government bond debt and then the pension funds own the rest, should convert its bond holdings into zero-coupon perpetuals. The difference between a central bank owning zero-coupon perpetuals and conventional bonds is that the former cannot be sold to withdraw excess liquidity from the banking system. That means the Bank of Japan would lose a key tool in controlling deflation. As inflation expectations rose, Japan's decade-long battle against deflation would be over. And in claiming that there are further benefits to the proposal, in one fell swoop, Japan's massive debt overhang would disappear. So it sounds like there was copy and paste stuff from the AP article I read a couple minutes ago into this article as well. Just crazy stuff, guys. So eventually, it looks like a lot of people were not aware, especially in the gold community and the alternative media, what Ben Bernanke said in 2016, because I wasn't aware of it. I had to hear Danielle DiMartino Booth mention it on interviews over the last year. She briefly mentioned it. She didn't name the time when it occurred. And Jeff Gundlach also mentioned it recently on an interview. And then I went back and did some more research on this stuff. So it appears that this has been discussed for at least the last 3 years, and this is becoming popular now. So it looks like this is all financial repression, Japanification. And the other thing I was thinking about, and this is going to sound conspiratorial to some of you, but, if you go to removing any interest income, any ability for retirees to earn any money on their savings, it's basically depopulation. You're controlling the population. My younger demographic, you're not getting any benefits from savings. If people are not in debt up to their eyeballs with student loan debt or auto loan debt or credit card debt or whatever, combination of those things. So it looks like that this could be with financial repression, negative interest rates, manipulating interest rates lower, stagflate and tax and layering taxes on as well, all one big economic and financial depopulation strategy. And there was also another survey that came out here in the United States earlier in July that 1 in 4 American adults believes that they will never be able to retire. And a lot of it has to do with the cost of living are going up. It's sad. And taxes are going up. And currency is being devalued. Oh, I'm going to the Ron Paul conference next month. So that's how I'm going to support ending the Fed, by supporting Ron Paul. The Ron Paul Liberty Report actually should be a very profitable business, and they demonetize all the videos. Trade Fee says a new financial system is required. I agree. And what is used as money now, this digital debt-based fiat currency, should not be money anymore. That's part of the problem. But capitalism is going to be blamed for almost all the problems in society. It's the main punching bag. I was just out at a restaurant, at a chain restaurant with my best friend, and we don't go to this restaurant that much anymore because normally the service is not too good, and sometimes the food is not that good either. Sometimes the pizza is really good, and sometimes it's bad, and they brought out the menu, and the prices were all in just like the last month. I hadn't been there in at least a month. The prices were all $4 higher on pizzas. The pizzas were all $4 higher. Chicken wings were all... I was having a cheap meal. The chicken wings were like $4 higher, so the prices just went up. Hey guys, keep it respectful in the comment section. I see F-bombs and other stuff being dropped. Please be respectful. No trolling, please be respectful. If you have a counter argument, be respectful. I put out that video yesterday about asking about the pension funds, and people are going to disagree. It's a very divisive issue, but some people were convinced that it would be one way or the other, and calling someone else stupid. Don't do that. The issue is far more complex. It's not necessarily black and white. Whoever controls Congress may start to give certain pension funds bailouts, okay? It's more complicated than that. Some pension funds are actually, with the Democrats in Congress now, I pinned a Real Clear Politics article at the top under that video yesterday, and there's a Real Clear Politics article that now that the Democrats are back controlling the House, they're already talking about some smaller pension fund bailouts. Okay, guys, so this is the reality we live in. It's more complicated necessarily than just black or white. So, looks like Ben Bernanke said some really important stuff during 2016, running up to the presidential election in November 2016 that a lot of people missed. And I went back and I found articles for you guys if you want to read and learn more about this. But it looks like starting in 2015 and 16, there was a big paradigm shift in policy change at a lot of the policy wonks, the PhD economists who are not Fed governors, but the lower ranks at the Fed. So the Fed has over 3,000 PhD economists that are grossly overpaid. A lot of them are hardcore Democrats. A lot of them are actually Bernie Sanders supporters now, I believe, too. The ones who were not Hillary supporters are Bernie. So either Hillary or Bernie. They normally don't hire any Republicans anymore from what I've heard. Okay, guys. Well, that's it for this short little update. And I'll put links to the Ben Bernanke article from March of 2016 about negative interest rates. He never actually wrote a second part. I was looking for it and didn't find it. But if you actually do find it, I spent 20 or 30 minutes looking separately for it, and I couldn't find it. So that's it for right now. It looks like a lot of the wonks in power are okay with negative interest rates coming to the U.S. at some point. Can't give a time frame when, but it looks like that's going to happen.